Ben, at the start of the year, we talked about an uncertain macro environment and the impact it might have. Where are we now?
Well, I think we were right to do that because we were in the midst of a very unusual inflationary backdrop. We were still, experiencing, monthly rate tightening out the US, and I think that was, obviously resulting in the spectre of recession and what that meant for corporate earnings and obviously the multiples that people are prepared to pay for assets. The good news, certainly as it relates to Ukraine, energy prices has been really one direction so far in that prices have come back a long way in energy. Some of the earlier fears around that and what that meant for various inflations have not borne out. That's been great. We've also seen some externalities associated with earlier rate tightening showing up in the financial system with Silicon Valley Bank and some of the other bank failures that I'm sure our listeners know all about. As a result of those things, and some evidence actually that consumer prices are beginning to come under control, has allowed the Fed, I think, to adopt a more of a wait and see approach. They've always said they were going to be data dependent, and the data's got better. So I think we can have more confidence that we're further through the rate tightening cycle than we were earlier in the year. And I think that's added, that's certainly taken away some of the risks associated with the macro environment that we called out earlier.
Okay, so what does the macro outlook from here mean for you as an investor?
So I've spent the largest part of my career worrying about macro risk because at the end of the day, I've been invested in one of the best sectors there's been to be invested in. So macro has always been a concern that potentially could upset an investment backdrop that you'd rather have. And so today, the proverbial wall of worry is strong. There are lots of things out there to worry about if you're so inclined. Inflation is not necessarily under control. It may just be becoming less problematic because the economy is weakening. We're hopeful that any recession, if it turns up, may prove shallow, but that may prove overly sanguine as well. We're hopeful that the largest part of the valuation compression that we've seen as a result of risk-free rates moving higher is behind us. But again, that might not be right if in the end the inflation problem hasn't gone away. But we have to think about those and place them in context with the opportunity set that we see as technology investors. And so far, our companies, certainly the best companies within tech, have been able to so far navigate a more difficult macro backdrop. Many of those companies are what we would describe as natural monopolies. So they've been able to pass on pricing. They don't have as much competition as perhaps other companies in other sectors have. And as a result, they've been wonderful places to ride out a more difficult macro environment. Again, we're hopeful that that will continue, but we also are hopeful that the strength we've seen in technology will broaden. Again, I think the healthiest markets are broad markets, and so we're hopeful that as the macro environment improves and as people get more confidence that perhaps some of those risks are not quite as bad as we earlier thought, that will begin to diffuse into the broader technology market.